Welcome to The Explainer. Today, we're going to talk about something that could totally change how you invest. What if I told you that picking the perfect stock might not be the most important thing? Seriously. We're going to see why focusing on the right industry can make all the difference.
So let's just jump right in with a pretty startling fact. Think about the year 2000. The dot-com boom, right? If you bought almost any decent tech stock, you probably did really well. But what if you'd bought the absolute best steel company at the same time? You would have seen pretty mediocre returns. So what gives? What was the real secret sauce here?
Well, the answer wasn't about picking the right tech company or the wrong steel company. It was about the industry itself. You see, it's this truth that so many of us overlook. We get caught up in the big picture, the macroeconomy, or we zoom all the way in on one single company's financials. And we completely miss this powerful middle layer, the industry. All right, so this brings us to our main point for this explainer. You know that saying, a rising tide lifts all boats? Well, that's true, but you got to make sure you're in the right ocean to begin with. Now, this quote, this really flips the script on how most people think about investing. It's not about being a genius who can predict a company's future perfectly. It's about spotting a huge trend, a whole sector that's about to take off, and getting in on it before the rest of the crowd does. Okay, so how do we spot these trends? Well, first, we need to get that not all industries are created equal. They each have their own kind of DNA that basically controls how they're going to act. They just behave differently. And really, it breaks down into two main types. On one side, you've got your cyclicals. Think of these like speedboats. When the economy's booming, they're flying across the water. But when things get choppy, they can get swamped. And on the other side, you have defenses. These are your big, sturdy ships. They might not be the fastest, but they'll keep you safe and steady when a storm hits. So what are these cyclical sectors? Well, here are the classic examples. We're talking about things like infrastructure and materials, industrial goods, and financial services. These are the sectors that absolutely thrive when the economy is firing on all cylinders, when money is cheap and everyone, from businesses to regular people, is out there spending. And then you have the defensives. These are the things we all buy no matter what's happening with the economy. Think about it. Food, soap, toothpaste. That's your consumer staples, or what people call FMCG. We always need medicine, which is healthcare, and we definitely need to keep the lights on, which is utilities. These are your safe harbors when things get uncertain. Okay, so we've got the two main types down, cyclical and defensive. But, that's only half the puzzle. The real secret, the art of it all, is knowing when to invest in each, and that comes down to timing the economic cycle. So let's look at phase one, early recovery. The storm has passed, and the economy is just starting to stretch and wake up. Interest rates are usually low. This is exactly when you want to get aggressive and jump into high-growth areas like technology and consumer discretionary. The stuff people rush out to buy when they finally feel good about the future again. Then, things really start heating up. We hit mid-cycle growth. The expansion is in full swing, and now it's the real economy sectors that take center stage. This is the prime time for industrials, materials, and banks. Basically, the engine room that powers a booming economy. All right, but then the party starts getting a little too wild. The economy starts to overheat in the late cycle boom, and you start hearing that word everywhere, inflation. At this point, you want to be in tangible stuff, things that hold their value, like energy and commodities. Those high-flying growth stocks, they suddenly look a lot less appealing.
And finally, the music stops. We enter a slowdown, and the entire playbook gets flipped on its head. Now it's not about making huge gains. It's about protecting what you have. So you sell those flashy cyclical speedboats and move your money into the safety of those defensive ships, like healthcare and FMCG.
But here's the thing, timing these short-term economic cycles isn't the only game in town. If you zoom out, you can spot these massive multi-year trends that are sometimes even more powerful. So how do you find them? Well, one great tool is the industry lifecycle. You just have to ask, is this industry brand new, just starting out, kind of like space tech? Is it in that exciting high-growth phase, like electric vehicles? Or is it all grown up and mature, like traditional banking? For an investor, Catching an industry right in that growth stage, that's the sweet spot.
And look, this isn't just a theory. We've seen this play out again and again. Just look at this timeline. Whether it was the IT boom in the 2000s, the infrastructure supercycle after that, or the more recent focus on pharma and healthcare, getting the big long-term sector trend right has led to absolutely massive returns for people who saw it coming.
So what's another big clue for spotting these long-term waves? Honestly, it's pretty simple. Follow the money. And I mean, specifically, follow where the government is putting its money. Just look at this number, 41,000 crore rupees. To put that in perspective, that's over $5 billion US. Now, that's not a company's profit. That's how much the Indian government is pumping into just the electronics manufacturing sector through something called Production-Linked Incentive, or PLI schemes. A PLI scheme is basically the government telling companies, hey, if you make more stuff here, we'll give you a big financial reward. And this isn't a one-off payment. It's a multi-year plan designed to give that whole industry a massive boost for years to come.
And it's not just electronics, not by a long shot. These PLI schemes are creating these incredible long-term tailwinds for a whole bunch of key industries. Auto parts, pharma, chemicals, you name it. It's almost like the government is handing you a roadmap, pointing to exactly where it wants to see future growth.
Okay, so we've talked about economic cycles and these big long-term trends. That's a lot to juggle. So how do you actually use all this? Let's boil it all down into a clear, simple framework you can actually apply. Here it is. It's a 3-layer analysis. Step 1, you start at the top. Analyze the economy. This tells you whether to be aggressive or play it safe. Then step 2, you use industry analysis. This is the crucial bridge that helps you find the exact sectors that are going to do best in that economic climate. And only then, at the very end, do you move to step 3, analyze the company. That's when you find the best boat to ride that rising tide. So, after going through all of this, what's the one thing, the single most important idea you should take away from this explainer? If you remember nothing else, I want you to remember this. Just let that sink in for a second. Being in the right sector at the right time often matters more than picking the perfect stock in the wrong sector. It's a really powerful idea, and it could completely change how you look at the market. So the next time you're hunting for an investment, just ask yourself, am I just looking for the sharpest needle, or have I taken the time to find the right haystack first?